All right, now before we dive into it, just want to review some of our recently posted content available on the YouTube channel. Just look up Power Options. Some of our last 5-6 videos that we've had using the market sentiment tool for call or put buying. What are the risks of long-term straddles or strangles, buying straddles or strangles? Analyzing parity trades, tools to evaluate parity trades for covered calls versus naked puts, maybe collars versus bull put credits or bull call debits, the vertical spreads, bear call credits, bear put debits, bull call debits, bull put credits. See, even I get confused from time to time. Finding rollout opportunities on power options using the portfolio tools for your positions. Are no-risk collars or conversions even possible? And a question that came into us via email that we posted on Wednesday, are you playing, well, posted on Tuesday, I believe, but are you playing the rate hike on Wednesday where we reviewed strategies we may or may not do in preparation for the event that we knew was coming up on Wednesday? And let's start there and maybe see how wrong I was or how right I was. Of course, we know what happened on Wednesday at about, 2 o'clock in the afternoon. We saw that the rate hike was posted at 0.75, another increase, third time in a row. I think that was the first time it was the third time in a row it's increased 0.75, or the first time since 1980 or some point, I can't remember. But an unprecedented event we knew was coming. It wasn't one, which I don't know how the market would have reacted with a 1% or 1 point rate increase from the FOMC, from the Fed itself. We have highlighted here is that 1 to 3 block on Wednesday, and we saw things sort of stabilizing, and we saw a little jump at first, and then everything went kaput. And Thursday, we had a mix, but we were still down. And where are we now? At the close of today, it rallied back up from 3 o'clock or so, 2 o'clock when I took this screenshot. But at 364, 363, we touched the low again of where we've seen here in 2020, from where we were several months ago. I think it was in, I apologize, I think it was in May or March, I can't remember. But in any case, we're back down to the low. It rebounded at the end of the day. You'll see that a little bit as we go through our next section. But the question that came in is, what strategies would you trade? And of course, our response was positions we would consider before Wednesday's known event were married puts following the rules in the blueprint, or standard collars to have limited risk, single-digit risk in place going into any known event with an unknown outcome. It could have gone up if the market was satisfied with the result. It could have crashed severely. We just didn't know. But having the controlled risk in place is what we do. We were expecting the market to swing one way or the other. We knew it likely wasn't going to be stable. It could have been. That's a risk. But knowing that the market's going to react one way or the other to whatever the monetary hike was, and in addition to that, whatever the comments were that Powell made after the hike came out. So buying a strangle or a straddle with proper position sizing in your portfolio to take advantage of both sides might have been a way to go. Positions we might consider, but they carry a high risk. And what do I mean by high risk? In the money covered calls, we have a high downside protection. You're collecting a high intrinsic value and some time premium. Or out of the money cash secured puts, where you have a high percent to break even, how far the stock could fall. We're using SPY as an example, until the position starts to lose. Positions some consider, but we see a lot of risk percentage-wise, were iron condors or iron butterflies, or if you just research the all-call condors or all-call butterflies. And positions we might not consider due to directional risk were buying calls and buying puts, or directional vertical spreads. Now we know which ones had the highest return. But you had to be right on the direction you thought the market was going to go and how the market was going to react after the event. Let's take a look. Married puts and standard collars. SPY down about 5.2% since we were in there. When we originally had this discussion, SPY was trading about 384 or 385. Let's just call it 385. But 384, I'm sorry, let's call it 384. 384.09. The married put, following the rules in the blueprint, we likely would have bought SPY at 384.09. And at the same time, bought the June 398 put, yes, expensive, at 34.75. So we would have 41,800, let's call it 41,900 invested but we're guaranteed to get back $39,800, so the risk is only 5%. It's $2,084, but it's a controlled single-digit percentage risk. A standard caller, shorter term, would have bought the stock again, maybe sold the 10th of October, 17 days out, 390 call, and bought the 370 put for a credit of about $2 on the position. The put gives us a controlled risk of only 3% for a 17-day trade. Now, the current liquidation value as of around 3:30 p.m. Eastern Time today on the married put was 1.9%. And the current loss on the collar is 1.8%. These were bullish strategies. But even with the 5% downturn since the trades were opened, both of them are only, well, the married put's less than 50% of the total maximum risk on the position. The collar's a little bit more than 50% of the maximum loss of 3%. Of course, both could be adjusted and rebracketed. The long strangle and the long straddle. Strangle, buying an out-of-the-money call and an out-of-the-money put, maybe more than 17 days out in time. I prefer to go, Victor, as you know. But in this case, we just use the example. We kept the 10th of October. And for the long strangle, at the time when the stock was at 384, when SPY was at 384, we just went 10 points out of the money, a 394 call and buying a 374 put. The cost was $975. And with the movement the last couple of days, we have a profit of $560 if we liquidated. So we'd get about $1,530, so our profit would be about $560. And that's a 57.4% return. The long straddle, buying the call and the put in a similar fashion, but at the exact same at-the-money strike price, the 385 when SPY was at 384. This was, on Tuesday or Wednesday. This had a cost basis of $1,818 or $1,818 for one contract. Current liquidation profit is higher. It's at $640 if we sold to close the call and sold to close the put around 3:30 today. And that's a 35.2% return because of the much higher cost basis, almost double, to get into the straddle because it's the at-the-money position where the time value of those two options is the highest. So, reasonable profits, reasonable losses that can be managed on the married puts and the collars. Positions that one might consider but carried risk, a deep in the money covered call. Buy again SPY around that 384, 385 cost basis. We could have sold the 370 in the money call, $14, $15 in the money for $19.04. The best max return is 1.2%. We're focusing more on downside protection, but a 1.2% return for 17 days, not too shabby if it worked out the way we wanted to. However, it didn't. The market fell. Monetarily, this loss is only 2.3%, but it's still a pretty high monetary loss because we invested in the stock position. We did collect $19 against it, but the stock has fallen roughly 20 points since we got into the position. Out of the money naked put. Parity trade, essentially. Instead of looking to make $438 on the covered call, collecting intrinsic value and time value, we just collect $435 for the same strike, the 370 strike, and it's down about the same, down 2.2%, with SPY falling 5.2% since the trades were open, or about 20 points. Condors, or butterflies. We use the iron condors and iron butterflies, but these would be parity trades to the all-call condors, all-call butterflies, all-put condors, all-put butterflies. But in any case, the iron condor we selected, we went about 25 points out of the money for a sold option. Sold the 360 put and bought a 355. Sold a 410 call, 415 call, bear call credit combined with a bull put credit. Now this one generated $1 worth of premium for a 5-point risk. Now most brokers will only charge you the margin requirement on one side or the other because you can't lose on both until you make an adjustment. Then the margin might change. But in any case, we consider this a net credit of $1, $100 per one contract, with a true max risk of $4. That's the most we could lose Yeah, we have to pay the 5 points if it goes below the lower put or above the upper call. But at the same time, we keep the dollar premium regardless what happens. It's a potential 25% return. But the current liquidation loss here is 63 cents. But that's only 15.7% of the maximum 4-point loss that we could take on the position itself. Okay, so and then the butterfly also. Iron butterfly. Now this one, what is the benefit of a butterfly? You have a much lower risk than you do with an iron condor. The risk here was only 162 or 163 because we took in about 838 or 837.50 of net credit. Because what are we doing here? We're selling two options that were right at the money at 385, the 385 put and the 385 call. And yeah, we kept the same 5-point spread, so we had to put some money into that too. But we took in about $838. The maximum risk is only around 162. But this position still has a loss of 27 cents. But it's lower than the Condor monetarily, but it's higher percentage-wise. Because, of course, the true risk was only 162. So 27 cents loss out of 837 versus 63 loss out of 100, or I like to look at it as a 63-cent loss on the Condor versus a 400 max risk, or $4 max risk, on the Condor, and a 27-cent loss against a true risk of 162, 163. So in any case, one or the other here, but the monetary loss is much lower on the butterfly because the higher premium collected, but they're both still losses. The vertical spreads. The ones I said I wouldn't do because you have to guess right on the direction. Well, if you guess right on the direction, you are smiling happy, and I know you are. I'm smiling happy with the trade that I had. It wasn't a trade I put on for the event. It's one of the trades we've been talking about that I've been playing with that was still in place, and I haven't rolled it yet because I'm waiting for more downside. But in any case, bull put credit spread. 25 points out of the money. I'm sorry, this was 20 points out of the money. What we would have done is sold the 365 put 17 days out and bought the 360. Usually I go for a higher probability. This one was around a 78 to 82% probability staying above 365, which probability doesn't include the unknown event that was coming up. It doesn't factor that in. It factors in implied volatility, but it doesn't factor in something that could change the market. In any case, it was a 74-cent net credit, a 17.4% return for a 5-point spread. Liquidation loss right now is at 141, or 33% of the maximum loss of 426. This one is tough for me. The market did come back at the end of the day. Most of you saw, I think it ended around SPY, I should say, ended around 369. As you know, if I've sold the 365 put option here, I'm using my 1% rule, meaning if the stock hit 368.65, 1% of the short put strike price, I'm considering managing it. Or if the loss hits 50%. Here would have been a tough one because I'm in my 1% range when I took this screenshot, but I wasn't at the 50% loss, but all of my other technical indicators were telling me to get out of this position. So I might have lowered the 365. One of the 8 ways to manage a bull put credit spread, might have rolled that down to the 362 or the 363. It would have lowered the net credit, but given me more of a buffer in these cases. But it's a loss because the direction was wrong, which is why I said it's risky to go ahead, or it's risky, to consider or go ahead with one of the vertical spreads because you don't know exactly how the market's going to react. But if you did the bear call spread or the parity bear put debit spread, you're smiling happy. Same range, 20 points out of the money from when SPY is at 385, selling the 405 call, buying a higher 410 strike. A little bit better net credit, 80 cents of net credit for a potential 19% return on that 5-point spread. The monetary risk was only 420. But the current gain, if we liquidate it, is 73 cents. That means we could close both legs and only pay 7 cents right now. So we're making 91.2% of the 80 cents that we expected. Had I entered this position or the comparable bear put debit spread, I would have liquidated it today when I saw the profit be 80, 85% for the 17-day trade. And if I was in this position, I probably would have managed it, as I mentioned, by using one of those 8 ways to manage the bull put. But I think I just would have lowered the put strike price down here if and only if I thought the downside was pausing. And it came back at the end of the day, but that doesn't mean that's what's going to happen on Monday. So that's the risk with those. Of course, you know it was going to be most successful. Long calls and long puts, which I said I wouldn't do because you had to get the direction right. And if you got the direction right, you're smiling happy. And in the money put, 10 points in the money, Tuesday or Wednesday when SPY was at 384, 385. The October 10th, again, I probably would have gone further out, honestly, with a long call, but this is just an example from that previous discussion. But it was 1351. The current gain is 1836, meaning we could liquidate the 395 put right now with SPY at 366 for about $31 and make $18.36 profit, or 135.9%. If you chose right in that direction, SPY, DJX, NDX, QQQ, what have you, then you're smiling happy right now. Or even if you did it the day after, you're smiling happy. The long call, again, we went 10 points in the money from some buffer zone. Actually, we only went 5 points in the money. I should have gone 10 points in the money, but we only went 5 points in the money. But again, would have cost us about $12.79. And you see the liquidation losses you'd expect is $10.07. We'd only get about $2 back. Less than that back. So we have a loss of $10.07 or 78.7% of what we invested into the position. That's why I wanted to go with the Strangle or the Straddle, because I didn't know exactly how the market would react. At a 0.75, if they did a 1 rate hike, I expected a decline like we saw, maybe even a little further. But then again, you never know when the comments come out. The institutions could have accepted that and said that's what we wanted to see, and the market could have gone up. I highly doubt it, but it's a potential. So if you guessed right, you're smiling happy. If not, that's why we play the Straddle or the Strangle for known events with an unknown outcome. All right, the profits and losses. Hey, the long put would have been the big winner. $13.51 cost, profit of $18.36, a gain of 135.9% for a 3 or 4 day trade playing the known event. The bear call credit took in an 80-cent net credit for a monetary risk of $4.20. Could liquidate it right now for a cost of 7 cents. You made 73% or 91.2% of the maximum profit you expected on the position. The long strangle, cost basis of $9.75, could be liquidated for a profit of $5.60, a 57.4% return. The straddle, higher monetary profit of $6.40 over the strangle, but we had almost double the cost basis of $18.18 versus $9.75, so it's only a 35.2% return, but higher monetary return. The long call, the biggest loss, $12.79. We can sell to close it now for about $2. We're going to lose $10.07 or 78.7%. The bull put credit spread, initial maximum loss of 426, current liquidation losses at 141. It's only 33%. It's not at my 50% rule, but it is or was within the 1% rule of when I probably would have rolled down the put in the bull put credit spread. Iron Condor, initial risk was $4, dollar net credit on a 5-point spread. Liquidating it would be a 63-cent loss or 15.7% of the $4 maximum. However, that you could say that if I took $1 credit and liquidating right now is a 63% loss, some people view that as you're losing 63% because you expect it to make 100, but you're actually losing 63. So you could look at it that way, but I look at it against the maximum risk. Iron Butterfly, lower risk for the higher net credit, only 162. Current liquidation loss of 27 cents or 16.7%. Now, the covered call and the naked put, the initial risk is infinite, kind of, right? SPY is not going to go into bankruptcy. If that goes to zero, you're all not here on the webinar. We're doing much other different things right now with our time if SPY and the S&P 500 goes to zero. Okay, but there is that infinite risk, which you would have used a stop. I would have used a collar or married put. But in any case, those in-the-money covered calls for protection, the out-of-the-money naked put, it's a loss of $800 because it's capital intensive. We had to buy the stock and we're losing on the stock, but that's only 2.2% of the monetary investment we would have had in the position. I lumped them together. They're essentially parity trades. Our married put, the maximum risk was 2084, or 5% of the cost of the stock plus the put. And we're at a loss of 865, which is 1.9% of the total invested, but 41% of the maximum loss that we could take on the position. And our collar, still 17 days out. Shorter term, we generated premium by selling a call, buying a put. We got more for the call than the put, so we knocked down the cost basis. The initial risk, 1158, or only 3% of what we invested in the position. Our liquidation loss is 669, or 1.8% of the maximum risk in the collar. But that's 50% of the maximum loss of 3%, I should say. So that's just that. And again, keep in mind, even though, let's just review, what would I probably be doing on these positions right now had I entered any of these? The long put, I'd take the profit off this position, and if I felt there was more downside in SPY, I probably would roll it down to a lower strike price. I'd take the profit off the table, maybe have a no-cost put in place in case SPY continues to fall. The bear call credit, I'm at 91% profit in 3 days with 14 days to go to expiration. I probably closed that out, took that off the table, and looking for a new trade. The long strangle, well, you guys have heard me been talking about this. Yeah, I've got a good profit in the position. It's had a good move down. It started to come back at the end of the day. So sometime today, hopefully near the bottom, before it started to move back up, it only moved up 3 or 4 points. So it's not a big move. I likely would have rolled the strangle to new strike prices, taken the profit off this one and rolled it down as we've talked about before. Likely would have done the same thing with the straddle position to reprofit that also. But I'd really like to see this at 50% or higher profit because of the higher cost. But if I felt that the market was going to stabilize here, which I'm not sure, by the way, I said I don't know what's going to happen Monday, but rebracket the strangle on the collar. Long call, not much we can do. Knock on wood. You can try to repair it with a butterfly. You know, we've got the video on the 8 ways to manage the long call positions that have gone against you. We could hold it for the next 10, 17 days and hope it comes back up a little bit so the loss is less. Turn it into a butterfly, as I mentioned, but not much you can do. The bull put, you heard me talk about, probably would have rolled the strike of the short put down. Didn't hit 50% loss, but it did hit my 1% rule, and the technicals are all going the wrong way. This one's tough. The iron condor and the iron butterfly. The losses are not that big monetarily, but they are losses. Maybe I treat the iron condor the same way as the bull put. I move the bull put side, the short put strike down one, or maybe move the put side down for more room and just leave the call side alone for the time being. It's going to reduce my maximum profit, but give me a little bit more buffer. Again, only if I thought the market was going to stabilize. It's hard to gauge. Butterfly is probably adjusting in one way or the other, but it's not in bad shape right now. If volatility in the VIX starts to come back down, we'll be in a better position, meaning that it won't cost us as much to close the position. Covered call on the naked put, as always, we could adjust these positions. The loss isn't that bad, only 2.2%. Market fell about 5% from when we got in. So we could use the position analysis and roll out opportunities on power options to see what we could do next. Married put, this, if I think the bottom has been hit, which again, I don't really think so. I'd be waiting a couple days, but once I think the bottom has been hit and we're starting to see a little bit of calmness, I won't say strength, I'm going to say calmness, then I'm going to use some of the income methods, such as income method number 9 in the blueprint, income method number 9 with maybe a 3 twist, or a 9 and a 1 combination. Collar might just rebracket the whole thing, evaluate what's there, or maybe just sell to close the put for the profit, roll the call down, treat it as a covered call. But the way the market is, I'd want to keep a put in place, so I'm probably rebracketing at that time since the loss is only 1.8%. So I hope that was a little useful. Chuck says, thanks so much for making all of these examples. You're welcome. I had them in the portfolio, of course, for the previous webinar that we showed on Wednesday. And of course, speaking of that, I just want to navigate back over here real quick. There we go. And of course, when we did that presentation, the Are You Playing the Rate Hike on Wednesday? There we go. Invisible Man made a comment, there are 2 times in a man's life when he should not speculate, when he can't afford it, and when he can. And that was a little bit better phrasing. What I said at the end of that first presentation is The most conservative approach may be to wait until after the known event. This would remove any sudden surprises or unnecessary risks, i.e. you picked the wrong direction. But in any case, I just wanted to point that out there. All right, but while we're here, now let's jump tracks real quick for Alice. And because Alice sent me an email, and Alice said she does have a few positions that aren't working out the way she wants to, and what can she do to manage them? And these have been flip-flopping throughout the day, just like everything was. But let's go ahead and take a look. Let's go to the portfolios. Yeah, here's play the rate hike. I'm just going to showcase this real quick. I know it's a little bit difficult to gauge, but no, sorry, folks. I want to kind of scroll this over. There we go. And so what we're looking at here is all the different positions, of course. Sorry there, I had to clear a bug out of my throat. The long call now is at a loss of 930, it looks like, or 72.7%. The long put's at a profit of 103%. It declined a little bit from the profit that it had. Our short put is down 1.3%. It was down 2.2. And this is our married put, is down 1.8 still. The covered call is down 1.5% instead of the 2.2% we saw earlier. And there's our bull put credit spread. It's a 101 loss now instead of 141. And the bear call credit spread still at that 89, 90% profit. This is the straddle, still at about 15, 16%. And there's the strangle, not as much money. You know, that's why I said I would have rolled it today, because we missed the opportunity. Remember, this was a profit of 640 at around 3 o'clock. And this was a profit of 520? 560, I'm sorry, 640 and 560. And here's our collar, down 1.5%, 43 cents instead of 63 cents in the Condor. And hey, look at that. Like I said, the butterfly went profitable as SPY went back up again. It went up to about 369 and then pulled back down about 368 or so. So now the butterfly is at a profit also.